Hello and welcome to Capital Ideas, where we celebrate the ideas that enrich our lives and the capital markets that make them happen. I'm Nick Morgan, co-founder of ICAN, Investor Choice Advocates Network, and one of the hosts of today's episode.
I'm Mark Hiraiti, Chief Legal and Policy Advisor with ICAN.
And I'm Dara Albright, co-host of Capital Ideas and proud board member of ICAN. And today, please join us in welcoming Paul Lovejoy to the episode. Paul is a registered investment advisor whose firm Stakeholder Enterprise helps investors invest with confidence, purpose, power, and without playing by the Wall Street rules. I love that sentence alone. Welcome, Paul.
Well, I'm thrilled to be here. I am a huge fan of ICAN and what you guys do. It's such important work, sticking up for investors' rights and really, preventing overreach and really standing up. It's such a huge service that you're doing, and I'm thrilled to be a part of this conversation.
Well, we're thrilled to have you on, and I've been following a lot of your work recently too, and reading some of your articles and things that you've come out with. And one thing that really intrigued me was you had stated that you said, through Wall Street, government regulators have been, quote, rubber stamping corporate greed for almost 100 years now. And I wanted to dive into that quote a little bit, and maybe you could discuss what you meant by that statement and how it inspired you to make 366 crowd-based investments in 366 days.
Yeah. Okay. So there's a little bit to unpack here, obviously. So in that statement, I'm saying, government regulators and corporate greed. So there's two elements to this. So if we could just, take a step back and take a look at the historical framework, context, it'll make a little bit more sense, that statement. So first of all, capitalism wasn't created in a vacuum. There was an entire economic system prior to capitalism, mercantilism, and where capitalism, the means of productions are in the hands of country's citizens. In mercantilism, the means of production are in the hands of the monarchy or dictator and their cronies. And so what happened is that wealth was concentrated during this economic system. And you had these large concentrations of wealth, which are, cancerous to markets. And what happened was, after the stock market crash of 1929, the SEC was formed to protect investors. Well, what happened is that the SEC made it so expensive to list and try and for companies to raise funds publicly, that the only companies that could afford to list on the stock market were funded by large concentrations of wealth from mercantilism. So you have this system that only allows companies with a lot of resources, a lot of money, to enter the market in the first place, into the public market. And this was horrible for a number of reasons. One, I just said, all you have are large corporations that can seek funding from the public, and it has essentially locked out small businesses and community organizations for 100 years from seeking funds from the public. And so it's created this wealth inequality that I would like to, that I see with this system. And I understand the SEC is trying to protect investors. That's why they said but it made it too expensive to do so. And what's even worse is that these the corporations in the stock market, this is all that people can invest in. And so now our 401ks, we're all in 401ks here. And guess what happened? Well, now it's just institutional investors now control the market. You have just a handful of institutions, more concentrations of wealth. So the SEC, whether it was on purpose or on accident, created a system where only large concentrations of wealth can flourish essentially in this country. And what's happening is they're not flourishing anymore. The companies, no one's listing on the stock market anymore. There was over 8,000 companies listed in the stock market prior to 2000. That number has shrunk to around 3,500. Companies want to stay private longer because they don't want to deal with these regulatory headaches. And that's why I love the Jobs Act, because in my opinion, this is the first time capitalism is actually being practiced. From my point of view, it's never been that the means of production haven't been in the hands of the country's citizens, because we haven't had the right distribution channels that we do today with the internet. And all of these rules that were created were prior to the internet and prior to digital footprints. And it's the landscape has totally changed. So that's why I'm saying government regulators are rubber stamping corporate greed, because that's all we're allowed to invest in. And to me, I now I understand why we live in a corporate bottom line world. This is the reason.
I couldn't have said it better myself. Exactly.
Oh, one of the things that ICAN is looking at is the proposal to expand the definition of accredited investor. Accredited investor, as you know, is a concept under Regulation D, which is the most often used exemption effectively for offerings that are not registered with the SEC. And as you mentioned, as the years have gone by, more and more offerings are conducted privately under Regulation D than they are in registered offerings. Given your experience, what are some of the changes, if you had a magic wand and could change the definition of accredited investor, which in the case of individuals are individuals with net worths of $1 million, excluding their home equity, or annual income of $200,000, what are some of the changes that you might make?
Well, I'm not a fan of restricting access to anybody. So that's kind of where the place I'm coming from. And as a registered investment advisor, I get deals sent to me every day. And a lot of them are Reg D offerings. And some of them are amazing. We're talking about direct lending, private credit, which is absolutely crushing the Wall Street and the financial returns since the 2008 financial crisis. So here we have this asset class, private credit. It's just doing wonderful. And it's sitting behind a velvet rope that says, not for you if you're a retail investor. And that just drives me crazy to see that happening. What I would like to see is that, here's another thing I just saw yesterday, was that there was 32,000 filings for Reg D offerings in 2024, and combined Reg A and Reg CF just had 652. I mean, that is mind-blowing, the difference of opportunity that you have. Now, granted, because there are less regulations with Reg D offerings, it's easier to defraud. And I don't disagree with that. However, maybe, I would put a warning label on Reg D portals and allow everyone to invest, and say, hey, these offerings have less regulations, so you're more inclined to be defrauded than the reg. So that's what I would do. I would get rid of it and put a warning label at something big, and let the consumers choose. And I mean, ultimately, that's why I'm in this space, to help empower and to prevent people from being defrauded. I was a defrauded investor in 2008. I lost everything. I was totally ruined, financially devastated. The shame I went through lasted for years. I don't want anybody to have to go through that. And guess what? The SEC didn't protect me.
Interesting. Dara mentioned at the top of this, your recently concluded effort to invest in 366 crowd-based investments over 366 days, which, if my math is right, that comes out to about one a day. Tell us a little bit about that. Like what prompted you to do it? What kinds of things did you see? Any lessons you drew? It's a fascinating experiment.
Yeah. Gosh, it was so eye-opening to do it. I just wanted to see, how well does this work? I mean, can I really give people a financial plan without Wall Street? And that's what I really wanted to see. Can I do this? And so what I did was, one investment every day. And the total amount that I invested throughout the year, 366 days. It was a leap year last year, so I call it my leap year portfolio. I don't know, it's kind of cheesy, but whatever. So I did this leap year portfolio, one investment every day, and I did asset allocation like any good financial advisor would do. I put 50% into income, 30% into equity, and 20% into balanced, which ended up being more like real estate, equity and income. And so my average daily investment amount was just $31.52. And the amount of diversification that takes place, I mean, we're talking about tiny, tiny, tiny little eggs in 366 baskets. I mean, talk about investor protection. This is a market-based approach to investor protection with the low minimum investment requirements. I mean, now get this, in one platform, you could invest less than $10 into short-term real estate loans. I'm talking about the ground floor platform. I invested in 432 different loans over the course of the year. 432. That's amazing. And here's something else. You know how many have failed loans? Two loans have failed. And because of the lien position in these loans, I didn't lose anything. In fact, I gained about 2% from these losses, which is, it's incredible. Now, another thing, I want to just keep on these minimum investment requirements. I invested in small businesses. Now, there are two different platforms that really offer good small business loans that you can crowdfund, these small business loans. And one of them has a $10 minimum investment requirement, and the other one has a $100 minimum investment requirement. So I invested $600 on one platform and $630 on another platform that does the $10. So I lost, one loan went into default in the one with the $100 minimums, and one loan went into default with the $10 minimums. The difference is that I lost $87 with a $100 minimum, and I lost $7 with a $10 minimum. This is investor protection right here. Bad things happen. Businesses fail. Regulations happen. Changes in economy, fraud, all of that happens, and it's so hard to kind of protect investors from that happening. It's almost, you can't to try and think that you can actually protect someone from an economic downturn. That's just not happening. The only way I see to do it is how banks have done it, and that is through massive diversification and to embed yourself into our financial system. So, yeah, I mean, I could go on and on about the three. I know I got a little sidetracked here, but is there any other follow-ups about it here?
I do actually, because you really touched, I think, on a really important point when you're talking about diversification and the ability to really spread it across a lot of different assets at a lower price. And what I think is really interesting about it, because you even opened up this session talking about how we, we're at half as many public companies as we've had from, just in the mid to late 90s. And if you think about that for a second, every single publicly traded asset or any asset, any investable asset for the masses are all byproducts of those public companies. So the less public companies you have, the less products, even bonds, mutual funds, the less diversification you have there.
Yep.
And it even gets even worse than that. There are out of that, maybe, let's say around 4,000 or whatever, how many public companies we have now. It's always changing. Say average.
Right.
Out of that, there were really only 250 publicly traded companies that have volume of over 5 million shares. So those are really the most actively traded. And then
Right.
it's even worse than that, when you're talking about the mutual funds, aside from the index funds, which will follow an index very closely, the mutual funds, in an average mutual fund, they may be holding, 100 stocks, and they're all the same 100 stocks. And when you get to sector funds, or, a fund that's really focused on a specific industry, I mean, then it gets even worse. They're holding like maybe 50 stocks, maybe 50 to 70 stocks. So you're talking about, people don't realize that they're getting like zero diversification in the publicly traded markets.
Yeah. It was what, 7 stocks basically control everything, the Magnificent Seven, give me a break. It's a big problem, Dara. Because our system was designed to concentrate wealth, restrict access, and just benefit a powerful few at the expense of everyone else, this isn't just unjust, it's dangerous. When economic power is concentrated in the hands of a few, it becomes easier to manipulate policy, suppress innovation, and undermine the collective agency of everyday people. It erodes democracy itself, transforming money from a tool of empowerment into a weapon of control.
So, Paul, on the investments that you were describing and the platforms through which you purchased them, did most of those platforms do you know whether they utilize the Jobs Act and Regulation A and Regulation CF?
Yeah, so I did a lot of Reg CF, over 90 Reg CF deals. Reg A, I did over 16 of those, which is kind of a lot if you know what Reg A is. And I also did Reg C, Rule 415. So that's Prosper peer-to-peer lending, which is your crowdfunding consumer credit, which I consider like kind of crowdfunding. It's not part of the Jobs Act, but there's also Ground Floor, which I mentioned earlier. Oddly enough, they use a Reg A disclosure format when you're looking at their offering circular. I was like, well, this is Reg A. No, it isn't. It's some exempt offering using Reg A disclosure. So that was interesting.
But what I wanted to ask was very interesting. You're talking about your returns from last year. Have you done any comparative analysis on a portfolio of these, with the kind of this alternative leap year portfolio versus traditional?
Well, here's the thing, Dara. We just don't have the infrastructure as financial advisors to aggregate all of these different platforms. It's a problem. But I have a feeling the market will solve this problem, and I'm even going to throw my hat into the arena to try and figure this out, because as a financial planner, I need to know the answers to these questions. And right now, it's too hard to integrate all these different platforms and to be able to spit out really good data. But I can share a few things with you, such as the amount of repayments I've had over the year. So remember, I invested $11,500, $552 to be exact, total for the year. And the loan repayments and also dividends that I received, total cash flow from just the first year was $1,220. And I got that money and I put it back in. And the 2 months since that has happened, it's now been 15 months. Total cash flow received has been $1,930. I mean, it's tremendous amount just from $11,500 to have that type of income coming in. And here's the other thing is, it's not locked away. I'm getting access to those payments. And let's say I need extra cash. Well, I can always tap into that. It's not something I have to sell and create a tax event for. It's something I have access to right away, and people need that. By doing this, we can have this access of more disposable income or cash when we need it, and growth when we don't.
And plus, you get the potential upside that you haven't realized yet for many of those equity positions, which, since they're early stage startup, I mean, if one hits, that alone could be substantial.
Yeah, well, I'm going to share one equity investment that I made. It was in this company called Invicta Water. It was, I just made the minimum $100 investment, and they had a valuation of just $5 million. And what they claimed to do was remove PFAS chemicals, AKA forever chemicals. I don't know if you ever heard that, from water. I was like, wow, they could do that. But this was just all conceptual. And, I was like, okay. And when you're at that case, it's not about studying numbers. It's about studying people. And so I was like, can this guy do it? And I was like, I think he can. And in October, they had a pilot project in the Haw River in North Carolina, and independently verified that they have removed all traces of the forever chemical, gone forever. And it's incredible to be able to be a part of that. And I mean, I'm thinking this company they got a patent since I've invested into this. They're the only ones that can remove PFAS chemicals. I mean, whoever came up with the word forever chemical, I think is going to make Invicta very wealthy.
Well, let me ask you this. So you've talked about, we're referring to it as your leap year portfolio.
Yeah.
Sounds like it involved around $11,000. So we're talking about a scale that's accessible to people who are not multimillionaires.
Right.
And as I think you have suggested, there will be some duds in there. There may even be some fraud in there. You're not suggesting all of these are great investments, but it sounds like the idea is you're getting sort of mass distribution and the diversification that comes with that. So, what were some of we talked about the accredited investor limitations. What were some of the other regulatory barriers that might prevent someone else from constructing their own leap year portfolio?
Well, something that drives me absolutely insane is the Regulation A pause. Oh my gosh, this drives me nuts. All of a sudden, like, I want to do dollar cost averaging. That protects investors. Dollar cost averaging, investing the same amount every month in the same thing. And this is a wonderful thing. There is a Reg A real estate investment trust called Roots. Phenomenal. It's great. They have a historical return of 17%. It's fantastic. They allow their renters to build equity along with their investors. It's a tremendous model that they've come up with, and nobody wants to leave because they're building equity in their places. So the occupancy rate is like 95%, which is unheard of. So anyways, I was getting ready to invest, and they're saying, sorry, we're in the queue to be evaluated. I mean, this is horrible. You're not protecting investors. This needs to be streamlined. And Roots wasn't the only time that this has happened. It also happened with Worthy Bonds as well. I've seen it. And so there have been some platforms to kind of figure a workaround, like Arrived. They use Regulation A, and they throw in like 3 or 4 houses. They're rental houses that you could crowdfund actual rental, and they throw in like 3 rental houses. And so that offering is done before they need to do that review again. So there have been some workarounds, but why do we need a workaround? Let's just streamline this thing. That's something that just drives me nuts.
Yeah. Oh, we'll have to take a closer look at that.
There's more also on regulations that bothered me. The Reg CF cap of limits. So some people can only invest a couple $1,000s into Reg CF. which is horrible for diversification. You're not protecting anybody. Well, I mean, unless you have some guy or gal or whatever, well, I'm going to invest $2,000 in this, that's a terrible idea to do. And I mean, frankly, you could make bad financial decisions anywhere, but I'm screaming at the top of my lungs, diversification, and that way, it allows people to hear some of this message, to not dump their entire $2,000 limit into just into one investment. So the cap, it just got to go.
Yeah. Is it fair to say that, looking back across the leap year model, you are a fan of the diversification opportunity, even if you're not in a position to recommend any of the particular investments themselves? Is that a...
Well, I spend a lot more time on the equity than I do the debt. Now, it's not like I didn't spend any time on the debt, because it's really, really easy, it turns out, to do due diligence on most of these debt raises. I'm talking small businesses. I'm talking, go down to your local coffee shop, lines out the door. I remember Yelp is like a fantastic due diligence tool in Reg CF. I was on Yelp all the time. I was on Google reviews all the time. And I'm thinking, okay, is this I'm looking at these reviews, I'm thinking, okay, is this a problem that's going to be going on all the time? Or is this something that's solvable? Because you can figure it out. It's all out in the open. So the due diligence for these raises, it's not challenging. You don't have to be sophisticated to be able to do this. That's a myth.
Right. Well, maybe we should come back in a year and see how the leap year portfolio did over that period of time. But in the meantime, Paul, you have just an amazing level of enthusiasm, which I really appreciate. And I appreciate you coming on. Maybe we'll leave it there for now. Dara, thanks so much for hosting. And Mark, thank you for coming on. And for the rest of you, if you want more information about ICAN, you can go to icanlaw.org. And we'll thank you and see you on the next Capital Ideas.